I call it the buy, hope, and pray model, where you buy and hold and be able to cash flow. You have to be doing value add in the process, which is obviously more riskier, but you have to be, that's the only way you're going to get alpha, I think, in these markets. And it's going to be like this for quite some time.
Welcome to the Real Estate Pros Show, where we interview real estate investing professionals from coast to coast, as well as the service providers that serve the real estate investing industry. Our goal is simple: share what's working now to help you improve and scale your business to the next level and meet the pros that can help you get there. Real Estate Pros is powered by Investor Fuel, America's leader in helping real estate investors and professionals build the business you need to live the life you've always dreamed of. Let's start today's show. Property insurance for real estate investors doesn't have to be difficult, but it does need to be there to protect you when you need it. MyInvestorInsurance.com not only provides insurance at 15 to 30% cheaper than traditional agencies, it's built specifically for real estate investors like you. You can set up an account in about 2 minutes, get quotes on properties, turn on and turn off insurance for your fix and flip or rental properties in around 2 minutes without having to talk to anyone directly, all through our portal. There's no better way or faster way to make sure you've got the coverage you need to protect you, and no more lengthy policies either. Once you're set up, you're billed monthly and prorated by the day for however long your policy is active. It's powered by MSI, the third largest independent MGA, with 1.5 million customers and more than $1 billion in cumulative premiums written. Get set up today in about 2 minutes at myinvestorinsurance.com/fuel.
Hey, everybody. Welcome to the Real Estate Pros podcast. I'm your host, Michelle Kesil. Today, I'm joined by someone I'm looking forward to chatting with, Lane Kawaoka, who is a real estate investor focusing on multifamily and, larger scale operations. So excited to have you here today, Lane.
Yeah, thanks for having me. Aloha, everybody.
Awesome. Let's dive in. First off, for those not familiar with you and your work, can you share what your main focus is these days?
Yeah, I mean, we focus on multifamily apartments in the real estate sector and residential properties. Kind of stay away from office, strip malls, stuff like that. But anything that involves tenants renting boxes to live in, that's probably more in our sector.
Awesome. And what made you get started as an investor?
Yeah, 2009, I was working a couple years as an engineer right out of college. I was told to go to school, study hard, and buy a house to live in and invest in the 401k. But because I was always traveling over for work, as a younger engineer, they kind of put you out on these projects. I was a construction supervisor back then. I just decided to rent out my house on a whim. And very early on, I was like, whoa, this is kind of cool, right? And I'll eventually be able to rinse, wash, repeat, do it again. Bought a duplex a couple years later in Seattle. And then by 2015, I had 11 rental properties. But up until that point was doing, just a little turnkey rental model, buy, hope, and pray model. But in 2016, started to get more involved in syndications and private placements as it became more of an accredited investor at that point.
Awesome. And what markets do you operate out of?
Mostly the red states. So your Arizonas, your Texas, your Alabamas, your Floridas. I guess some would call those the Sunbelt states. But, lately after the summer of 2022, when interest rates up, we've kind of had to definitely pivot. So I'm a little bit market agnostic. It depends on the deal. If we're buying something where we're able to pick it up at $250 a square foot and able to sell it in, current market comps are 500, I quite honestly don't care where it is. I mean, obviously I want it to be in America where I feel like we have the best legal system. I don't know if that's a good thing, but that doesn't preclude me from, we've done deals in New York City, very blue state, but it depends on the deal. If the deal is rather just a buy low, sell high flip job, I'm okay going to blue state. But if I'm going to have tenants for long term, more than a year or two, I definitely want to be in one of those Sunbelt red states.
Yeah. And so you mentioned having to pivot. Is that just location-wise, or are there any other type of pivots that you have been doing?
Yeah, I mean, in 2022, interest rates skyrocketed, 40-year high, quickest time in history. I mean, if you had floating debt, you got absolutely killed if you're not talking about it, you're lying, or you haven't been around doing deals in 2016 to 2018. I think you're seeing a lot of new operators come and being bored today because they just didn't have to go to that, which I guess good for them, right? It's better to be lucky sometimes.
If you're looking for consistent, high-quality leads, look no further than Investor Machine. Investor Machine isn't just another agency. It's the most sophisticated, data-driven lead generation company on the planet for real estate investors, and serves the role of being not just a lead generator for your business, but a marketing partner that is helping you achieve your goals along the way. Go to investormachine.com to learn more and schedule a call with our team today.
But yeah, when interest rates went higher, the hard thing is like when you buy these loans, typically if you're doing any type of value add plan, you're buying it with a 1 to 3 year or even 5-year bridge note. The reason being is you have enough time to be able to add value to the units. But if you're unlucky and the market corrects 20 to 30% downside, like we've seen over the last couple of years, you're probably underwater on your senior debt at that point, even if you've implemented your business plan and increase, the NOI. So at this point, unless you had like 5-6 year debt and greater, the properties are really not marked to market today, right? And I think that's what you're seeing in the institutional world. A lot of these big property owners, even the ones that start with B, those big guys, they are owning a lot of these assets, and yeah, they're paying their pref, but they're owning assets that are worth 70 cents on the dollar than it was 100, and they haven't marked to market that yet in commercial real estate. It's probably been a bigger impact than the 2008 financial crisis. That was more residential pricing where there's a lot more transparency, where in the commercial markets, again, I keep saying this term, like you don't have day-to-day mark to market, where the prices are actually marked to what they're actually worth today.
Yeah, definitely. There's a lot of nuance and uncertainty there.
Yeah, and I think at this point, interest rates is one thing. That's a big part of your debt service. But I've seen, like I've had a 300-unit apartment complex that we bought in 2020 where the taxes were $150,000 when we first got started. And then, recently now it's like over $400,000. Right. So these line item expenses keep going up and up and up. And I think it's just getting harder. Right. I mean, maybe I sound like I'm complaining a bit, but I think that's the nature of any game out there. It just gets harder and harder to compete. So I think you have to rely more on heavier value add. No longer can you just change out some flooring, change an appliance, charge tenants $50, $100 new tenant appliance package. You have to do even more value add. Right. I mean, when I first got started buying little rental properties in Alabama in 2012, I was able to buy a nice Class B property for 80, 90 grand. That rented for 900 to 1,000 a month. Today, that same property rents for about the same thing, go figure, but it's about $140,000, $150,000. So that obviously your debt service is a lot higher because your principal amount on your loan is a lot higher. I mean, it's just getting harder and harder, right? And you no longer can just buy properties and, I call it the buy, hope, and pray model, where you buy and hold and be able to cash flow. You have to be doing value add in the process, which is obviously more riskier, but you have to be, that's the only way you're going to get alpha, I think, in these markets. And it's going to be like this for quite some time.
If you're looking for consistent, high-quality leads, look no further than Investor Machine. Investor Machine isn't just another agency. It's the most sophisticated, data-driven lead generation company on the planet for real estate investors, and serves the role of being not just a lead generator for your business, but a marketing partner that is helping you achieve your goals along the way. Go to investormachine.com to learn more and schedule a call with our team today.
Yeah, what does value add look like?
Value add could be, from a mathematical point of view, it's anything you're doing to increase the net operating income. So net operating income is the delta between your income or your expenses. So if you can increase your rents or charge people trash valet or all these other, cool ways to make money through the other income category, you can increase your top line revenue. I think most times we're doing that, right? Because, it's, as I think a lot of people follow Uncle G, Grant Cardone, right? It says and it follows suit with your personal finances too. It's easier to make more money than it is to save it. Of course, you utilize artificial intelligence and you put in better business practices from the previous seller that, you used to own the property recently, where you're trying to cut costs here or there, bring in better property management, streamline things to save some costs here or there. But obviously with expenses going up due to inflation, it's hard to kind of hold your expenses, hold that line. But it's a two-front war, right? You're increasing income and decreasing expenses, and that's what increases your NOI. And since we're all real estate investors, especially in the commercial realm, your property is valued based off your net operating income divided by the prevailing cap rate. So whether that cap rate is 5 or 6, you don't have control over that denominator, right? The denominator is that prevailing cap rate. That's what assets are traded for in the market. You have control over that numerator, that thing on the top of that equation, right? And net operating income. So if you can impact that, that's how you impact your sales price at the end of the day.
Yeah, absolutely. And what are you most focused on solving or scaling to next?
I talked about the SWOT analysis initially, right, before our pre-call here. I kind of look at, I know this is a real estate investing podcast, and I love real estate. I think the tax benefits, it's one of the most archaic businesses out there, right? Renting boxes to people to live in. I don't think that's going to be going away anytime soon. I still like the workforce housing sector because the rich are getting richer and the poor are getting poorer, and the middle class is shrinking to the lower middle class, which hopefully they rent apartments from us. I think that though long term, this is really impacted by interest rates, right? And because that's really what impacts the commercial real estate prices out there. And I think every investor needs to have the Chatham Financial Curve and the CME FedWatch tool bookmarked. Now, they don't need to be anal like me and check it every couple of weeks, but they definitely should be checking it at least once a quarter or a couple times a year and seeing where they're essentially like the Vegas odds. I think there's that betting website out there that everybody likes, like Kalshi. I don't know how to pronounce it, but what the FedWatch tool is for CME and the Chatham Financial Curve is, these are the rate cap providers that people like us will use. So these guys got skin in the game and they're not messing around. So they put out forecasts on where they think interest rates are going to be going in the next, coming years, decade plus. It's obviously just an estimate, right? But I think it's, obviously large institutional firms use these as the backbone for a lot of their financial models and predictions and the forward-looking statements. And I think it's, for a mom and pop investor, it's definitely something that you should have bookmarked on your desktop and check it from time to time.
Yeah. So in terms of like what you're looking to scale to next, what is that?
Yeah, I think it's just being opportunist. What I try and invest in are things that are going to be around on a 10-year trend. So for example, I'm not going to bet on who's going to be the next leader in the next 1 or 2 years in the AI race between OpenAI, Gemini, Claude, etc. I want to make my bets or my investment theses around things that I think that are going to be long-term sustaining, such as workforce housing, I mentioned. Another thing is, energy. With AI becoming more and more prevalent and, with people, so much energy goes into a silly ChatGPT request, right? And we haven't even seen the widespread adoption of this by regular people. Energy demands are going to be going up. So that's why, I invest in oil and gas, and also for the great tax benefits where you don't need real estate professional status. And, so that's something that I'm bullish on. I do think that at some point it's going to push the country and the world to go nuclear, although there's a lot of, careful on how I choose my words here. There's a lot of people that don't like that for obvious reasons, because they think a Homer Simpson runs every nuclear power plant out there and they think it's rather dangerous. I'm not going to comment on whether it's safe or not, but I do think that we're going to be going that direction. But for now, the vast majority of money is going to, old school oil and gas. And I follow like what the big guys do. If you look at Berkshire Hathaway, Warren Buffett's company, and KKR, and the guys who start with B, if you look at their portfolios, they invest in little green energy, but the vast amount of their portfolio is still the tried and true oil and gas market. So that's another thing I do. I kind of spy on what the big guys do. And you guys can set your own alerts up yourself, right? Like I mentioned a few: Apollo, KKR, Blackstone, BlackRock, Berkshire Hathaway. You can kind of see insights on the way that they invest and what big trends that they're investing on. Other things that I like, I like things that do well in wartime. Not that I like war, but I'm always thinking, well, what's the next black swan event that's going to happen in the future? So for me, I think that's a war. Right? We're already seeing a couple of them happen right before our eyes. And so what that means is like I want to invest in things that are more of an infrastructure play. I think I don't want to invest in SaaS products and software anymore because we've seen the disruption. Any joker can get a vibe coded product out there and the barrier to entry is so low.
If you're a new or newer real estate investor looking to launch or grow your real estate investing business, please check out Investor Fuel Club. It's a coaching community, but unlike anything you've ever seen before. And you can actually partner with members of our mastermind from coast to coast on deals right in your market. There's no better opportunity to build a consistent business than to literally partner with pros to help you avoid costly mistakes, avoid the need for capital to do deals, and help you eliminate your fears as you're starting your business. Learn more about Investor Fuel Club at investorfuel.com/club.
I think that there's a huge opportunity from that blend between where digital technology and where there's huge displacement with AI and when like the physical land. So I haven't really synthesized what exactly that is yet, but maybe an example would be an electrician, right? A highly technical trade, but you need the guy to go in there and fine tune it and install it. Whereas, at one time, this like a week ago, I was thinking, plumbers is a good way of playing it, right? Because you need the guy to go in there and turn the wrench. But, that's a system, like, the toilet is rather standard, right? Where I could see them automating that process. Whereas, when you're going in and installing, say, a data center, it's a lot harder for you to, automate with robotics, etc. So these are the ways that I'm kind of thinking of playing it. With that investment thesis of, what if in a war, what if in a recession, I don't like short-term rentals. I think they're like one of the worst things to invest in because let's look at it, guys. Like, when do you go on a vacation? When do you use a short-term rental? When economy is doing well. When the economy is not doing well and your stocks are taking a crap, you do not go on vacation and you do not use these cool Airbnbs. I think we're in a bit of a bubble with that type of stuff. And it doesn't, and also you could just be shut down by the municipality making a tax or a political play to take you out, right? I mean, I live here in Hawaii. Hawaii is very against Airbnbs, and I'm not going to get into the politics of people taking homes away from the residents, but I know it doesn't do very well when people are renting out $200 a night Airbnbs, where like the big companies are grabbing $500, $600 a night hotels. Obviously, that goes to your big companies, but a lot of that flows down to the residents here in Hawaii, right? So that's not good for the economy. So there's a lot of politics against shutting down little Airbnbs to block that type of stuff. So maybe the lesson learned there is whatever you invest in, try to look at it from a legal standpoint and political standpoint, right? Be on the riding tail of something. And I think that's where workforce housing has a good thesis around that, right, too. Not to get too much into details, but that's a little bit of things kind of on the investment front that I'm thinking of these days.
Yeah, it's definitely an interesting perspective. And so are you continuing to invest in real estate, or is that something that you're more cautious about?
Yeah, I still will always invest in real estate because I haven't settled upon this for myself. Like, what's my blend of real estate? I've been wrong in the past. Like, I mean, I grew my net worth pretty greatly from 2000, and when did I buy my first rental? 2009. And I caught a good wave with real estate. And some of this is market dependent, obviously, but I put my money where my mouth was, and I put 100% of my net worth. I pulled my 401k, I pulled my Roth, and we bought rental properties. And then we went into syndication deals in 2016 plus. And I rode the wave, but in 2022 to 2024, commercial real estate came down 30% off the peaks, and I got punched in the face pretty hard. And I'm realizing myself that I was not diversified. I think at the time I had maybe 90% of my net worth in that stuff. I think the rest was in, infinite banking, life insurance, thankfully. But, I don't know if, I'm not a financial planner, so don't listen to me, but I'm kind of like, well, it'd be nice to have maybe a portion in real estate, right? Stuff I've done in the past, real estate syndications, apartments, things I know. Another quarter in real safe stuff like life insurance, closed-end funds, another quarter in private equity, right? That's where investing in businesses that are, higher risk, higher return, obviously. And then maybe another section in private credit, right? If you're not familiar with private credit, it's one of the biggest things that Wall Street is getting involved in these days, with banks kind of pulling back in that sector after 2008. But it's essentially, think of it like a bond. You're investing more on the debt side of deals, or in this case, private businesses that are underwrote, by professionals. But that's kind of what I'm thinking for myself personally. But my new book, The Wealth Elevator, I talk about the different stages of the wealth building game. I'm on the higher floors, floor 3, 4, and above. If your net worth is 0 to 1 million, don't listen to a thing I'm saying. You probably should just buy little rental properties like I did from 2009 to 2015, 16. Yeah. And then, most of the folks I'll interact with these days are passive investors. We do events for folks that are accredited, that are, now trading in the rental properties and getting involved into larger deals as an accredited investor, because they don't want to really own real estate because of the legal liability, which I was there at one time. When I was broke working my engineering job, I wasn't too much of I know, I mean, people could have sued me back then, but they can't get too much blood from a rock, is what they say. Not giving anybody legal advice, obviously, but and plus, I didn't know as much as I knew now back then about that type of stuff. But you talk to accredited investors, and I think every investor should have at least 5 accredited investor close friends to be able to interact and bounce this stuff around. But yeah, I think it's a big issue that you hear all this financial advice out there, investment advice, but at what point in the journey does this make sense? So in my book, The Wealth Elevator, I have different floors of the wealth elevator. First floor, second floor, third floor is kind of when you've hit 4 to 5 million net worth, where if you wanted to, you just put all your money in T-bills and chill. That's what the term I've kind of used lately in some blog articles, T-bill and chills. Once you have 4 or 5 million and you get, the 4% rule, some people are familiar with that, you could probably just rest on the laurels. Like, most of my clients need maybe $10,000 to $20,000 of passive income a month, and you probably get that from that nest egg. And then you don't need to invest in real estate or crazy, syndication deals. But, that's kind of where you hit these different net worth thresholds and different floors of the wealth elevator, and then strategies kind of change from there.
Yeah, absolutely. Thank you for sharing your knowledge and perspective and viewpoints. Well, before we wrap up here, if someone wants to reach out, connect, and learn more about your book and what you're up to, where can people find you?
Yeah, they can check out The Wealth Elevator on Amazon, and if they buy a copy and they leave a nice review, they can shoot us an email, team@thewealthelevator.com, and we'll hook them up with the PDF version. So if they're smart, they'll throw it into AI and ask to get their own personal questions. But we'll also hook you up with the MP3 version there too. So if you're a bad reader like me, we'll just read it to you, apparently. But yeah, if you like podcasts, check my podcast, The Wealth Elevator. But yeah, thanks for having me, Michelle. Appreciate it.
Yeah, thank you for being here. And for those tuning in, if you got value, make sure you've subscribed. We've got more conversations with operators like Lane who are building real businesses, and we'll see you on our next episode.
Thanks for joining us for today's Real Estate Pros Show. You can learn more about the amazing benefits of the Investor Fuel Mastermind community, including surrounding yourself with hundreds of other rock stars, 100% financing for your deals, and members-only discounts from vendors you're likely already using that, as a member of Investor Fuel, will save you more than the cost of your membership. Visit investorfuel.com to learn more. If you're interested in joining us as a guest of this show, please visit investorfuel.com/pros to apply. You can also check the show notes for access to free resources, how to get access to world-class lead generation, and much more. Don't forget to subscribe so you never miss another episode. Have a great day. We'll see you on the next show.